If you're thinking about buying your first rental property in Canada, you need to learn how mortgages work so you can choose the right product for your investment. Most new investors focus only on interest rates, but that's not what actually determines whether a property cash flows or whether you can refinance and repeat. Hi, I'm Anne, mortgage agent and real estate investor, and I help Canadians analyze rental properties and finance them strategically. In this video, I'll walk you through Mortgage 101 for rental property investors, including where you can actually get a mortgage as an investor, lender types, residential versus commercial mortgages, fixed versus variable rates, amortization, stress tests, privileges and penalties, so you understand how financing really works before you make an offer. By the end of this video, you'll have a solid foundation to start choosing mortgage products based on strategy, not just rate. Let's begin. In Canada, you have two primary ways to arrange a mortgage, through the bank branch or through a mortgage agent or broker. At the branch, you're limited to that bank's products and rates offered by their sales representative. With a mortgage agent, we shop the market on your behalf and give you access to mortgage products from multiple lenders, offering you more options. As an investor, working with a mortgage agent gives you an edge. We're usually free to use, except in rare cases with private or non-prime lending. We have access to 30-plus lenders, from major banks to credit unions, mortgage finance companies, alternative lenders, and private lenders. We act in your best interest, structuring a mortgage that supports your investment strategy, not just your affordability. Our in-depth product knowledge helps you select not just the best rate, but the right product, based on your goals, risk tolerance, and upcoming projects. There are two primary types of mortgages available: residential and commercial. Residential mortgages cover properties with 1 to 4 units. This includes single-family homes, multifamily homes up to 4 units, and condos. These properties all qualify for residential mortgage rules. With residential mortgages, your personal profile matters most: your income, credit, debt ratios, rather than solely looking at the property's performance as an income-producing assets. This means the financing process is simpler than commercial lending, with more familiar requirements and timelines similar to buying a primary residence. Commercial mortgages, on the other hand, are typically for properties with 5 or more units. Think of them as the solution for larger investments, like apartment buildings or office spaces. With commercial financing, your personal profile matters less, but you'll need a property that performs well financially, and you'll be expected to show that you can operate it successfully. In this video, we're focusing on residential mortgages only, meaning properties with 1 to 4 units. Next, we'll talk about the different types of lenders. Lenders can be categorized into 3 categories: A lenders, which are the major banks and credit unions; B lenders, which are the mortgage companies and alternative lenders; C lenders, which are private lenders. As mortgage brokers, our role is to thoroughly understand your situation and match you to the right lender based on your income type, your credit profile, your financial ratios, your down payment, and your investment strategy and financial goals. This is the difference between getting a no from a bank and a yes from the right lender who matches your specific situation. Now let's talk about the 2 main mortgage rate types: fixed and variable rate. With a fixed rate, your interest rate stays constant throughout the term of your loan, keeping monthly payments predictable. Good for investors who want stability and budget certainty. Then we have a variable rate, which is a floating rate. A variable rate doesn't have a fixed interest rate. Instead, the rate is tied to the Bank of Canada rate decisions. The Bank of Canada schedules 8 rate announcements yearly, impacting floating rates. In a slow economy, rates may drop to encourage lending. However, in times of high inflation, rates might rise to curb spending and bring inflation down. For variable rate mortgages, your mortgage payment is either static or adjustable. If static, the amount applied to principal and interest is adjusted, not the payment. Meanwhile, with an adjustable rate mortgage, mortgage payments fluctuate with changes to prime rate, keeping you on your amortization schedule. For investors, this choice directly impacts both monthly cash flow and how flexible your mortgage will be if you plan to refinance later. Do you prefer stability in your payments? Opt for a fixed rate, especially if you can't afford payment fluctuations. Thinking of making changes during your term? Consider a variable rate with its flexibility or a shorter-term fixed rate. Once we determine your rate type, we strategically choose your mortgage term. The mortgage term refers to your contract length and the duration for which a specific rate is locked in. Many people focus on rates as the primary way to save money on a mortgage. However, the most significant savings come from selecting the right term and amortization for your mortgage. Most lenders offer terms ranging from 6 months to 10 years. But how do you decide? Similar to picking a rate, the right term aligns with your long-term goals and economic conditions. Investors often opt for shorter terms if the strategy is to do a buy, reno, rent, refinance, repeat, to refinance or break the mortgage before the end of the term, or longer terms if the strategy is to buy and hold. This is exactly how I structure my small multifamily deals, when the goal is to renovate and refinance within a couple of years. Once we establish your rate type and term, the next step is determining your amortization, which refers to the time to pay off your mortgage. If you're putting less than 20% down, you're required to qualify on a 25-year amortization, which gives you insurable pricing, the lowest rates in our pricing tier. Keep in mind that you have to qualify for your amortization, and that the shorter the length of time, the higher the mortgage payment, which potentially means you qualify for a lesser amount. However, if you have more than a 20% down payment, you can go as high as a 30-year term. Investors often opt for this option, which offers better month-to-month cash flow. This is a great option when combined with prepayment privileges, so you can pay down the mortgage faster while benefiting from lower monthly payments. Another factor in choosing your rate type and term is the stress test you need to take to qualify for your rate. This financial assessment is implemented by financial institutions. It assesses a borrower's ability to manage their mortgage payments if interest rates were to increase. Borrowers are stress tested against either the higher of minimum qualifying rate of 5.25% or their contract rate plus 2%. This ensures that borrowers can manage their payments if interest rates rise in the future. Lastly, the two terms you will need to know about your mortgage are prepayment privileges and prepayment penalties. Prepayment privileges refer to the amount you can pay on your mortgage before facing a penalty. Generally, you have two options: lump sum payments, which allow you to put down 10 to 20% of your remaining balance per calendar year. Secondly, an increase to your mortgage payment. This enables you to boost your mortgage payment by 10 to 20%. The benefits of utilizing prepayment privileges include: 1. Faster mortgage payoff. Using prepayment privileges allows you to pay off your mortgage more quickly. Even small additional payments can significantly reduce the total time needed to pay off the loan. 2. Interest savings. Paying more towards your mortgage means less interest paid over the life of the loan. As interest is calculated on the remaining balance, reducing the principal amount decreases the overall interest accrued. And finally, prepayment penalties. Prepayment penalties occur when any payment beyond the allowed amount triggers a penalty, typically when breaking your mortgage before its maturity date. For variable and adjustable rates, penalties typically involve a 3-month interest penalty, varying between lenders depending on how they calculate this against your contract rate or prime rates. With fixed rates, the penalty is the greater of either a 3-month interest penalty or the IRD, interest rate differential. The IRD calculation involves comparing the discounted rates and posted rates, calculating the difference in interest fees left to pay based on both rates. Investors often pay close attention to products with better prepayment privileges if their strategy is to do a buy, reno, rent, refinance, repeat, to refinance or break the mortgage before the end of the term to avoid large fees. As you can see, mortgages involve much more than just interest rates. Understanding the different lenders, but also your financial goals, income type, and risk tolerance, are crucial in selecting the right mortgage for your rental property. A mortgage broker is there to guide you through all available options and assist in choosing based on your unique investment strategy and situation. And if this video helped, make sure to subscribe. In the next video, I'll walk you through how credit scores actually impact your borrowing power as an investor. If you'd like help analyzing a rental property or understanding how much you can qualify for, I've included a link below to my rental property validator and my strategy call calendar.